Let's get more on how the president's plan is playing out with private equity investors. Joining us right now is Don Marron, a private equity investor, Wall Street veteran. He's also the CEO of Lightyear Capital and a former director of Fannie Mae. Long Wall Street and financial background. Don, great to have you back with us.
Nice to be here.
So what do you think of the president's plan?
Well, I think, first of all, the president's plan, I'm sure, partly comes from a frustration that we've had a crash, the markets come back, and not very much has happened.
Right.
Not much in the way of regulations, nor probably from his perspective, not much in the change in the financial institutions.
So this is basically, is he sending a message to lawmakers like, let's do something already, do something more significant?
Well, he's sending three signals. The first one is we don't want organizations to get too big. Second one is we want them to take less risk. And third, we want them to be in simpler businesses that we can understand and more transparency.
All right, but the way
he's got a plan for each one.
But do you agree with his plans?
Well, I think the principle is right. We obviously can't have this too big to fail situation. My view is some of these companies are simply too big to manage, and that's one of the things. And the question is he focusing on the right thing? He puts his name behind proprietary trading, and he mentions 5 times private equity and hedge funds. That's a small part of the thing, and that's not what caused the problem. What caused the problem was extraordinary credit and then lowered credit standards. And the combination of the two has affected everybody throughout the world.
And that's the point that seemed to come out big time yesterday. Many folks saying, you know, he's not getting at the heart of the problem. It was bad bets on real estate and bad investments based on those bad real estate loans.
Well, I think that's part. He's getting at the heart of the problem in one way. It is probably correct to limit the size of the nation's banks.
You really think so?
So you can't consolidate everything in a couple of institutions. But the size is still going to be immense, some big percentage of GDP and other things. It's certainly probably correct to be able to limit risk if the government is investing in these institutions. And it is in any depository through insurance. And finally, my belief is one of the best things to do is to have more transparency. If the markets understood more what we were creating, what we were trading in, they could adjust better.
Seems pretty basic.
Seems pretty basic. It hasn't happened.
Let me ask you though. I mean, you're a private equity firm.
Right.
Does it bother you kind of that the president is going kind of after the private equity angle, or do you benefit by this potentially?
Well, Larry Summers, in an interview last night, was quick to point out it wasn't going after these things. They just felt that they should be separated. Well, take private equity. The banks have raised $80 billion in private equity funds over the last few years, since 2006. They're raising about 18 more. $50 billion that's unspent. There are also about 9% of the investments in private equity firms. So if you had to divest all that, you, as Barney Frank would see, would need years in order to have it happen. Would it make a big difference in the running of banks? I don't think so. It might hurt somewhat in relationship with their corporate clients. Would it be hurtful to the whole industry? Only in the effect of change. This is a very good business. It's a business in which we buy companies and not stocks. We have a very long time horizon.
Right.
There's much less leverage than there used to be. So I can understand wanting to do it. And it's not a core business for banks.